Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The signals coming from the G7 before the meeting itself was, we're going to stand strong with Ukraine. They don't mention really Israel or Taiwan at all, the other two major hotspots. The president probably concluded that it was much better to get back to the sit room and figure out what was going on with some precision and map out a variety of potential responses.
It appears, as you look at it right at the top, that it's weak, right? But if you really dig down into it, what you see is that it's auto sales and building material that really dragged it down. So I don't think it's as negative as the headline number tells you. I just think that consumers are becoming more discerning because some prices are out of control.
Historically speaking, these kinds of Middle Eastern dust-ups haven't made much of an impact on global supply, but there's always a first time, and this one has the wild card, of course, of Trump. And the Iranians have only limited response to put pressure on oil, in the Straits of Hormuz, which historically speaking hasn't been much of a threat. It's been well known inside Iran that the United States will not allow a closing of the Straits of Hormuz, so the threats tend to be ignored, and they have been, for the most part, ignored.
We got 1 hour to go until the market closed, and we're taking a look at the major averages here that are a very different story from yesterday, of course, Josh. Now, yesterday, we had headlines on Iran and Israel. Today, we have headlines on Iran and Israel, and the market seems to be reading them more negatively today. We did see President Trump leave that G7 summit early in order to try to address what seems to be a worsening situation here, or at least not an improving situation in terms of any kind of pause in the hostilities happening. And indeed, President Trump sort of upping the rhetoric against Iran a little bit. So all of that equaling the Dow falling now by some 0.75% today, the S&P 500 down by about the same amount, and the NASDAQ down 0.8%. And we also, of course, continue to watch the effect on oil. Now, where oil yesterday was lower, today we're seeing it climb back up to $75 a barrel.
Yeah, I think I think geopolitics front and center for sure. Israel, Iran is still running red hot. I think you're right to bring up those posts by the president, Julie. The president saying Iran has to surrender. We also had the vice president posting as well. And so I think as investors, everybody's kind of reading those posts and trying to think, what, if anything, comes next? Does that mean the U.S. is going to weigh actively joining Israel on these attacks on Iran? We don't know. We also did get economic data today. We got weaker than expected retail sales. We also got reports on housing, on industrial production. They were tepid, right? All ahead, of course, of the Fed meeting tomorrow.
Right. Specifically, those retail sales numbers falling 0.9%. If you back out autos, you get a much smaller drop of 0.3, but nonetheless, still a drop, and it was still worse than estimated. How is this all playing out when we look at the individual groups within stocks? You got consumer discretionaries, one of the worst performing groups between the retail sales and the sort of broader macro worries. You've got healthcare kind of switching back and forth there, and you've got energy that's in the green along with those oil prices. You also have the other sort of broad group that was green yesterday that's red today is large cap tech. You see a lot of declines there. Tesla in particular down 3.7% today. T-Mobile standing out to me as dark red in the middle. SoftBank selling a stake there. And so, whereas yesterday felt a little more risk on, today exactly the opposite.
Microsoft, of course, the journal report that Microsoft, OpenAI, maybe bit of a rift there, Julie.
Yes,
we'll talk about more later in the show. Well, for more on the latest market moves, though, let's welcome in here Michael Kino now, the Permanent Portfolio Family of Funds President and Portfolio Manager. Michael, it is great to see you. When investors today, Michael, they got a lot on their plates. I was talking to Julie there. Israel-Iran war is red hot. President Trump posting about that, demanding Iran surrenders, of course. Trade and tariffs front and center as well. Michael, how, as a long-time portfolio manager, Michael, how are you trying to navigate all this?
Yeah, good afternoon, guys. Well, I mean, if you're really super conservative, you can still get reasonable returns on cash with short-term treasuries, 4.5%. So that's one way. we tend to think that over the long term, you'll be able to do better by having a broader mix of asset classes and being very diversified, which, is no secret for us. So we're pretty spread out between equities, bonds, and commodities, for gold and silver, for example. And in our equities, we're spread out in a variety of different industry groups because they're performing very differently, and some have better value prospects over the long term than others. And on the bond side, we're still relatively short, although we are opportunistically looking at, medium duration versus short duration. But still, we think interest rates are higher for longer. We don't think the Fed's going to do much tomorrow. Although the data is starting to weigh a little bit to slowing, I don't think it's substantial enough to hurry up and make a rate cut per se. But it does keep the watchful waiting story alive going forward to the next meeting.
All right, Michael, I want to drill down on some of the different asset classes, and I want to start with gold, actually, because it's doing something today that I wouldn't have expected. It's falling, right? Which is not something you would expect from gold prices on a day when you're getting headlines out of the Mideast that are hitting risk assets. So not only do you have that happening, you have Citigroup saying that the run in gold is over and it's going to go back below $3,000 an ounce in the coming months. So I'm curious, first of all, your reaction to the move today, and then to that Citi call as well.
Well, everybody's got an opinion. You can get informed people on any side of any issue. There are other people saying that gold has a lot more room to run. So we'll find out in a few years who's right. But I think that gold is, obviously down today, but it's been up the last week. It's been up and down the last couple months. We don't watch it over a day-to-day basis. We believe it's a substantial part of a longer-term portfolio. As an alternative to cash, as an alternative to the economic system, as a hard asset, as a hedge against the dollar, economic and inflation risk, whether it's real or perceived, et cetera, et cetera. If you look at the case for it, central banks are buying very strongly around the world. The Fed is likely going to be cutting versus raising. That's bullish for gold long term. You've got, potential challenges to the U.S. dollar as the world's reserve currency. Probably not a full-blown takeover, but countries are starting to get together and accepting payment in other ways besides the dollar. That's not bullish for the dollar. And you've had the dollar running at like decade highs until recently. And that's sort of been bearish for gold, yet gold has still performed. And that dollar value is likely going to decline over time. So that's another, bullish factor. And you look at geopolitical risk, which, as you guys have mentioned, is all over the place. So I think when you add all that up, the story's compelling for gold going forward over the long term. Now, can it correct in the short term? Easily. Gold's volatile. I mean, $100 move one way or the other, $200 move would not be out of the question, up or down. But I think over the long term, investors should figure out how much they want. And years from now, it's going to be higher, I would guarantee it.
So that's your take on metals, Michael. On equities, I am curious, what are the kinds of companies, Michael, you're screening for right now? What are the characteristics you're looking for, and what pops up on that screen?
We tend to look for companies that are can control their pricing power and can control their cost structure. And then with that, we basically analyze it in light of relative value. Some industries trade at higher premiums than others, et cetera, et cetera. And so we look to be long-term investors. We look for a multi-year time horizon, and we look for broad themes in light of economic circumstances. And then we look to see who the winners are going to be, maybe within those broad themes. So we tend to have a pretty diversified portfolio of equities designed to be individual long-term growth stories. And so, currently, and I think that describes our portfolio, both on permanent portfolio and our aggressive growth multi-cap core strategy. So with that in mind, certain times are more beneficial for buying and selling. I mean, for the better part of the last year and a half, we weren't really doing a lot of buying. We've been a little bit more active lately because there's been some value opportunities given the sell-off a couple months ago with Liberation Day, some of the geopolitical risk, et cetera. So, I mean, we've tried to take advantage of that. And you have had short opportunities in technology, but they've moved quickly. So if you blink, you miss them. Then other industries like energy, like materials, like natural resources, you're trading at below market multiples with companies that pay solid dividends. So long-term stories in energy, for example, I think would be very attractive. We like financials. We like technology. We like industrials at some level. So we're pretty diversified in terms of what we've been buying. But there's no question the broad market right now is getting rich again after that sell-off in early April.
One of the stocks you like within technology, I understand, is NVIDIA, a stock that once again is approaching its record highs. But as we know, because NVIDIA makes a lot of money, the PE doesn't always, skyrocket. So how do you think through that one? I mean, certainly when you talk about pricing power, feels like that's one that has some pricing power. So does it tick all of your boxes?
Yeah, it's funny. I mean, us and everybody else with NVIDIA, right?
Right.
But no, it's been a long-term holding for ours and for us, and so we still like it. There's a reason people are buying things like an NVIDIA, right? They're growing revenues substantially every quarter. They're growing cash. They're increasing market share. They're in a bunch of different sort of subsectors where their chips are desirable around the world. So, I mean, it's a great company to own. You do have to worry about, is the news too good? Are they going to have inventory gluts, or are people going to be buying? Are there going to be price controls or export controls? I mean, those are all fair questions for a skeptical investor to be asking, regardless of where that goes. In our case, it's been a long-term holding. And yes, it's a premium multiple, no question. And for large parts of the last couple of years, we wouldn't have gone near it in terms of buying it. However, after Liberation Day, when prices were way down, I mean, we tended to liberate some of our cash during that period, to point of phrase. And NVIDIA was one of those companies that, for a brief moment, traded very cheaply. Broadcom was another one, and so we look to add and increase our position at those times for that company.
Michael, great to see you. Thanks a lot for joining us.
Thanks. Anytime, guys.
Thank you. Well, we've got an update on the status of President Trump's tariff battle as the U.S. Supreme Court has been asked to consider striking down some of the president's sweeping tariffs. For more, let's welcome in Yahoo Finance's Alexis Keenan, our resident legal expert. So we turned to you when we saw these headlines because we're trying to make sense of whether this will actually go to the Supreme Court and then what happens.
So this is a petition to the Supreme Court, and it's in one of two cases that have been bubbling in the lower courts, not too low, the appellate courts at this point, the federal appeals courts. And this case, it's two toy companies, American companies, that import products from overseas. They're private family-owned companies, and they're going to the Supreme Court with a petition saying, you need to decide this matter now. It cannot wait. And so it's a very rare type of petition to ask the Supreme Court to make a decision and weigh in before an appeals court has even issued a decision. So in those two underlying cases, we're still waiting for the appeals courts. We're still not even to the point where both parties have submitted all of their arguments in writing to the appeals courts. So in this petition, these petitioners say whether the president has authority to impose the tariffs is of such imperative importance that it warrants review now, they say, in light of the tariffs' massive impact on virtually every business and consumer across the nation. These challenges cannot wait, they say, for the normal appellate process. So they want to get an answer from the court. The court, though, has no obligation to give them what they're asking for. The court has full authority to step in or not step in at this juncture.
As you said, it's very rare for these petitioners to make this kind of a request with this urgency before the appellate court. We always think of the Supreme Court, the highest court in the land, things kind of move up the appeals ladder until it gets to them. Right. So it's been rare. How rare is it that the court grants that request? It's something that the court is there to do, right? So if they feel that this appeal is of the nature that these petitioners are saying it is, and that is an imminent threat, they certainly can give this kind of relief. They could do a number of things. They could go ahead and start listening to the case. They could expedite it. They could decide to issue an injunction that is maybe different from what the appeals courts have done. Maybe it goes in the other favor of these importers and these companies that are asking for the relief. At this point, we just don't know, but they certainly have the authority to do this. And look, the Supreme Court's term is coming up on its conclusion here. It usually used to be kind of the end of June. Now we kind of spill over into July a lot. I would think that if they're going to address it, they want to address it while they're all still there and present and working on the cases, but they're not obligated to do so. All right, Alexis, thanks so much for deciphering it for us. As always, we appreciate it. We're just getting started here on Market Domination. Coming up, the FOMC has begun its June meeting with investor focus on tomorrow's rate cut decision and the dots. We're going to preview what to expect on the other side. Plus, solar stocks are seeing their shares fall today after the Senate unveiled revisions to Trump's tax bill, and they're not favorable for those companies. We're going to break down some of our top trending tickers later in the hour. Stick around, much more Market Domination still to come.
Well, this week, investors will not only learn the Federal Reserve's latest interest rate decision, they'll also get a look at updates to the Fed's summary of economic projections. And Yahoo Finance's Jennifer Schonberger joins us now with more. Jen.
Hello, Josh. The Federal Reserve kicked off their two-day policy meeting earlier today in Washington, where they are widely expected to hold interest rates steady at the conclusion of their meeting on Wednesday. But the bigger question is whether Fed officials still see 2 rate cuts this year. Back in March, let's rewind the clock, officials retained their outlook for 2 rate cuts from December. Many think the Fed will maintain 2 cuts at this meeting as well, for the sheer reason that there's still so much uncertainty around the outlook from the impact of tariffs, tax policy and immigration on inflation, the job market, and overall growth. For that reason, not much is expected to change when it comes to the Federal Reserve's economic forecast either. As of March, the Fed saw inflation rising 2.8% this year from 2.5% projected back in December. The unemployment rate was seen ticking up to 4.4%, and GDP was seen slowing down to 1.7% this year, down from 2.1%. Tariffs have whipsawed from extremely high to being honed in to be more moderate, while uncertainty still persists over what the actual tariff rate will be. Economists from Goldman Sachs and JP Morgan see the Fed upping their outlook for inflation but lowering their outlook for growth, with the latest inflation readings having clocked in milder even with tariffs on full blast in April and in May. One question for Fed officials is whether they still view the risk that inflation from tariffs could prove longer lasting, or whether it's just too early to judge the impact from tariffs and that perhaps inflation from tariffs hasn't yet been seen. Another question is whether the Fed sees any cracks in the labor market. Investors will be looking for whether the Fed leaves the door open for a rate cut later this summer. Guys?
Jen, thanks very much. Looking forward to tomorrow. Well, for more on where the Federal Reserve may be headed with interest rates, let's bring in Natixis CIB America's chief U.S. economist, Christopher Hodge. Chris is with us here in the studio. Thanks for being here.
Thanks, Julie.
So the question of how long-lasting the tariff impact on inflation will be and whether it will even exist is sort of hanging over us. When and how are we finally going to answer, are we and the Fed finally going to answer that question?
It's the big open question right now, and I think after we saw the growth contraction in Q1, we've seen growth indicators for Q2 be fairly strong. As far as the labor market's concerned, we see some sort of pockets of weakness, but we don't see anything acute right now, and we don't see anything immediate right now as far as softness in the labor market is concerned. Inflation is the big open question. We haven't seen much of an impact of tariffs on inflation in the previous 2 prints. But we do think that as businesses need to run down their inventories and restock at higher prices, those costs are going to be passed on to consumers, and we think that's going to happen in July, August, and September.
And how would you expect, Chris, then consumers to react to that?
Well, we think it's going to be, we think consumers have already started to pull back on spending just a little bit. We've seen precautionary savings go up, and tariffs are going to be an additional tax on consumers. The reaction function of exporters, importers, and consumers is very much up in the air right now. So how much of that cost is going to be passed on to consumers is the thing that we are watching over the next few months.
And of course, what consumers are expecting is also important, right? I was looking at a chart today from the Wall Street Journal about those inflation expectations. So whether you look at University of Michigan, in which they're extremely elevated, the New York Fed, which seems a little more moderate, businesses as judged by the Atlanta Fed, how much do we need to take into account the idea of whether inflation expectations are anchored, as the Fed might call them? In other words, are people expecting to have to pay more?
Yeah, most of these inflation indicators, whether or not they're based on surveys or based on hard data, they all show something pretty similar. And that's a pop in inflation in the next year or so. But the 2-year swaps, 5-year swaps, 10-year swaps, they're all pretty well anchored at a little above 2% right now. And the Fed is going to really want to be concerned that those are not becoming unanchored. So even if we get a pop in inflation in the next year or so, we do think that the longer run expectations are going to be well anchored. That's going to allow the Fed to cut in October.
I'm curious, just get your take on what you made of that weaker than expected retail sales report today. I saw some economists making the case, Chris, they telling their clients, listen, it was really due to a drop in a few components like vehicle sales. And their point there was we saw some pull forward demand, and now what you're seeing is some give back. But I'm curious to get your take.
It was the volatile items mostly which brought down the headline number. The core component was still fairly solid, and it's pretty consistent with a consumer that's willing to spend, but being a little bit more choosy now.
I was interested in some commentary from one of your peers on the street over at Jefferies, looking at the grocery store and restaurant components specifically. And yes, you did see a downtick in restaurants during the month that was measured, but you know, over time, generally restaurant spending's held up pretty well, especially compared with food at home, which would indicate consumers feel okay. Is that how you're reading it also?
Absolutely. We do look at the retail sales at the component level and break it into the discretionary and the non-discretionary, right? You're not going to choose to not pay for healthcare. You're not going to choose to not pay for toiletries and clothing. The more discretionary items, restaurants, sporting goods purchases, et cetera, et cetera. And we have seen that flatten out a little bit over the past few months. Which, you know, combined with the fact that defensive savings rates are increasing a little bit, we do think that means that the consumer is being a little bit more cautious now.
Gotcha. Chris, thanks so much.
Thank
you
for
coming in. Now time for some of today's trending tickers. We're watching solar stocks, Eli Lilly and Verve Therapeutics, and Pure Cycle. Let's start with solar stocks. They are dropping again. This is after the Senate unveiled its revisions to Trump's tax bill. The adjusted copy of the bill ending solar and wind energy tax credits, phasing those incentives out 4 years earlier than originally intended from 2032 to 2028. This comes at a time when solar energy is seeing less demand, especially with California slashing credits for excess power. And what's interesting is, you know, there was also a pretty strict phase out in the House version of the bill, but there had been some hopes and intensive lobbying happening on the part of those in the industry that there would be more favorable conditions in this Senate version. Lo and behold, Josh, those favorable conditions are not to be found.
Yeah, now lawmakers could still make changes. I mean, the Senate is trying to, you know, pass and send this bill back to the House by July 4th. We'll see what happens. But reports do note the odds appear to be fading that lawmakers intend to make changes to preserve credits for residential solar companies. I do see Guggenheim analysts cited as saying hoping for a fix continues to be naive, they said. The Senate bill, though, would rescue a tax credit for nuclear power. So that's in there.
Yes, at least for now. It gets a later phase out. I mean, we're looking at Plug Power on there as well, hydrogen producer, and the Senate version of the bill gets rid of an incentive that provides for hydrogen production specifically. I mean, the concern with many of these companies, Plug Power included, is that they will not be able to continue, perhaps even as a going concern, might not be able to continue in business for some of these companies if they don't have these incentives. Plug Power has come out with some, there has been some talk about Plug Power in that category, but certainly it's going to be a big hit to these companies if it goes through as expected.
Sunrun down 40% there. We are also watching Verve Therapeutics shares. They're soaring after the announcement that Eli Lilly will be buying that gene editing company for up to $1.3 billion. So that was the news. Lilly making moves. Bloomberg reminding us they've been on the hunt. In January, they agreed to pay as much as $2.5 billion for a cancer drug being tested by Scorpion Therapeutics. In May, they announced a plan to buy Site One Therapeutics for as much as $1 billion. Lilly had been collaborating with Verve on its experimental gene editing program for reducing lipoprotein A. With this now, of course, Lilly would have full control.
Yeah, and a couple things to mention here. Why is Lilly being so acquisitive? I mean, they got Zepbound, which is a blockbuster. Well, like any big drug company, eventually it's going to lose patent protection. In the case of Zepbound, it doesn't happen for a decade, but they're trying to look ahead at these experimental therapies. Secondly, as you mentioned, the specific product that Verve is working on is a cholesterol drug, effectively, aiming at improving cardiac health by targeting cholesterol. Our friend Evan Seigerman over at BMO said that there's already a lot of cholesterol treatments out there. So he was more skeptical about the deal, but other analysts say that this does fit well into the Lilly portfolio. So there's a little bit of debate here about whether it's a good deal for Lilly, but the shares are down a little bit today.
All right. We should get Evan on, explain that thesis.
We should.
Yeah.
Finally, Pure Cycle Technology is reporting that it plans to grow its plastic recycling capacity to 8 billion pounds before 2030. The company designing new solutions to recycling plastics, also announcing it's executed binding agreements for a $300 million capital raise. The company is projecting EBITDA of $600 million by that 2030 deadline. This has been an interesting stock.
Yeah.
It de-SPAC'd back in 2021. And it's also more than doubled over this past year, although it's down from the highs where it was.
Recycling tech, Julie.
Yes, exactly.
Yeah, the CEO saying time for growth is now. Apparently noting production progress of the Iron Ton facility, talked about momentum in commercialization efforts, confidence in financing efforts.
A couple other things to mention about this one. When it did first de-SPAC and it spiked, after that, it was accused by investors of misleading them about its technology. The CEO ended up being subpoenaed by the SEC
A lot of drama.
in 2021. There was a lot of short interest at the time, and I just checked. 30% of the float of this company is still shorted. So there still appears to be
And
a lot of
not a ton of
skepticism
coverage
out there.
on the street.
No.
3 buys, 2 sells.
Yeah.
There you go. Coming up, JetBlue shares falling as the airline is sounding the alarm on weakening consumer travel demand. We're going to discuss the latest on their side. Stick around. Much more market domination still to come. JetBlue is sounding the alarm on weakening consumer travel demand by cutting flights. For more, bringing in Yahoo Finance senior reporter Brooke DePalma. Brooke.
Good afternoon. Certainly, JetBlue is sounding the alarm here when it comes to the impact that we're seeing now because this weary consumer environment that we've seen because of the impact of tariffs over the past few months. JetBlue CEO saying in an internal memo that was obtained by Yahoo Finance, quote, "We're hopeful demand and bookings will rebound, but even a recovery won't fully offset the ground we've lost this year, and our path back to profitability will take longer than we'd hope." She went on to say in that memo that in order to keep the airline running, they're still relying on borrowed cash. The JetBlue saying in this memo key ways that it plans to cut spending and also save money. That is, some of those ways include cutting flights. What's going to impact consumers here most broadly? They're going to reduce flights on days like Tuesdays and Wednesdays, and also in markets where they have a lot of offering of flights. They said that's already reflected in the schedule. They also plan to change routes. They're winding down underperforming routes and shifting to cities with more profit potential. She also said they're pausing upgrades to their Airbus jet, and also we may see some potential leadership cuts come to JetBlue. The company saying in this memo that they're assessing the size and scope of their leadership team and has identified ways to combine or restructure certain roles for greater efficiency. So ultimately, JetBlue looking to save money in this environment where more and more consumers are cutting back, saying, hey, maybe we won't fly this summer. Maybe instead we'll take a road trip.
Interesting. All right. Thanks so much, Brooke. Appreciate it. Pharmaceutical stocks are sinking after President Trump saying the tariffs on the industry are coming, quote, very soon. For more, bringing in Chris Meekins, Managing Director and Washington Health Policy Research Analyst at Raymond James. And Chris, man, you must be busy lately because we have the president saying that. There's some other reports about ad curbs potentially on the industry. You're looking through the tax bill's latest version. So you got a lot to sift through when it comes to this industry. I do want to start with that tariff headline. Obviously, this is something that the president has been bringing up periodically, and yet those tariffs haven't come yet. So how are those in the industry dealing with it? And do you see the drop in pharmaceutical stocks as indeed related to that sort of tariffs hanging over their heads?
Yeah, you're right. It's a busy time in Washington, D.C. Add on to that, I have a 4-month-old at home as our second kid. So
congrats.
If you have any sleep to spare, I welcome it. Or if you can urge, fewer headlines that get people's attention, I'd be open to that too. To your point, though, on the pharmaceutical industry, obviously, we get in this situation where something gets announced, people get very worried about it, as was 2 months ago with the Section 232 waiver. And then we had the comment period close the beginning of May. And people kind of lost track of it. And then obviously the president got the question on Air Force One last night, said it's coming soon and could be 25%. And that got the attention yet again. The reality is this president is very focused on trying to lower drug prices. And probably more important to him is the idea that Americans are not being taken advantage of by having to pay a higher price than other nations. So he is going to look for actions, whether it is regarding tariffs or whether it is with most favored nation policy proposals or adjustments at FDA. He's going to look at a lot of different tools in his toolbox to try to go after this.
For Trump as well, Chris, another priority is increasing domestic manufacturing, including of medicines. So would tariffs as a policy tool, Chris, would that help achieve that objective?
Yeah, obviously, if you have a discount for producing things here, which oftentimes are more expensive than producing them overseas, you could see some pharmaceutical companies change production and try to move them here. However, that's not an overnight change. It takes a long time to be able to build both the manufacturing and do the training of employees so that they can follow the good manufacturing principles to actually produce quality drugs that Americans can count on as being safe and efficacious.
Chris, I'm just curious, when we talk about the countries overseas who are the big, meaningful providers of these medicines, which countries make the list?
Yeah, obviously it depends on what you're talking about, right? When it comes to generic drugs, you're looking at China and India. There's a good bit. If you look at the active pharmaceutical ingredients, which go into almost all products, you see same countries, China and India, toward the top of that list. And then when you look at other products, we think of weight loss drugs. Oftentimes those are from Europe as well as other places. So it's a pretty broad swath. I think there is a national security concern, and we've been talking about this for more than 3 years. I talked about it years ago when I worked on the executive order on the Defense Industrial Base when I was a senior official at the Department of Health and Human Services. This idea that, we like to bring manufacturing and products so we can make sure that we have the guns we need and the planes we need and the drones we need and all these products. But if you don't actually have drugs to keep your sailors and airmen and soldiers safe to operate those things, what good is that? So when we're looking at how to make America resilient, there is a concern about making sure we have the pharmaceutical products we need here to be able to ensure the country can continue to respond in any given situation.
Chris, from an investment point of view, between the tariffs and the push to manufacture more of these drugs domestically, are there certain drug makers that are in a better position from either or both of those perspectives compared to some of their competitors?
I think what was interesting was when the president announced his executive order on drug pricing, and the topic of tariffs came up during that a little over a month ago, is that he said, Eli Lilly's going to be fine because they're investing in the U.S. I think when they're looking at these tariffs, they are trying to find a way, whether it's through waiver authority or some sort of credit, that if you are investing in manufacturing in the U.S., maybe you don't have the same tariff as other companies and other products that are not investing in the U.S. So he is trying to encourage that domestic manufacturing. How exactly that looks, I think, is an open question. Investors are constantly watching for the next move, but the trade officials have a lot on their plate right now. And so I think what the exact timing of the 232 pharma waivers may get pushed out a little longer than what people appreciated.
And Chris, there's another report out there that I wanted to ask you about as well. There's been some reporting that the administration is looking at some ways to throw some sand in the gears of drug advertising, direct-to-consumer drug advertising, that they couldn't ban it outright, but there are ways that they could make it more difficult for companies to do that. And I was looking at some estimates, $10.8 billion spent last year on this type of advertising. How much did these companies get out of it? And if it would be made more difficult, how much would it hurt them?
I mean, I think it would be material if you could actually make the change. I think that Congress would have to act, and even if they did, there would be challenges to that. You know, Congress was able to ban some of it in the tobacco industry more than 40 years ago, and then the rest of the changes in advertising happened after we saw this global settlement with the state AGs and what they agreed to do. I don't think the pharmaceutical industry is interested in that, but I think there's going to be significant pushback, not just from the pharmaceutical industry, who believes that there really should have the capacity to inform patients about products that could help them, but also from everyone who's receiving it. You want to see some pushback in DC, go after Pharma and watch the television companies and watch the social media companies and watch anyone who's a recipient of what some estimates say is like 20% of all ad dollars in the US is from the pharma industry. You know, I think there would be significant pushback. And while Senator Sanders and King, both democratically aligned senators, no Republicans have signed on to the bill in the Senate. And I think it's going to be really hard for this administration to do it on their own with an outright ban.
And speaking of Congress, Chris, we didn't even really talk about the big, beautiful bill, right? So I'm curious, from a healthcare policy perspective, what is the thing that you're watching most closely within that bill?
Yeah, for the pharmaceutical industry, there were some changes to the Orphan Drug Act that would have been more favorable to them in the House bill, did not get included in the Senate bill. We'll be watching those developments. But the biggest focus has really been on Medicaid provider taxes and state-directed payments, which are very niche, matter to hospitals, matter toward how these facilities are being funded to make up for what are historically lower Medicaid payments compared to other payments. A lot of focus there. We will see a very interesting dynamic where the bill may cut or save $1 trillion in healthcare spending, but when you peel back the onion, the direct impact to state budgets is probably less than $200 billion over a decade. And for providers, it's probably a fraction of that, because we think the CBO's estimates for how many people are going to become uninsured are probably double what they end up being. CBO are very nice people. They just tend to be off by orders of magnitude that would get either of us fired if we were consistently that wrong when it came to projecting what enrollment's going to be in healthcare programs.
Wow, shade against the CBO, Chris. Thanks so much for being here. As always,
they gave me a bad score when I was a staffer. I've not gotten over it.
Oh, understood. Thanks a lot, Chris. The CEO of embattled DNA company 23andMe is betting big on a turnaround. For investors, it's a chance to reset the narrative. For consumers, the spotlight is back on transparency and what could happen to their very personal data. Our senior legal reporter, Alexis Keenan, back with us now to get us up to speed on what is going to happen with this situation.
Yeah, very personal data, the most personal data. So tomorrow there is a hearing in bankruptcy court in Missouri, and it is so that the parties that are against it, mostly a group of U.S. states and some others, against a bid from the co-founder of 23andMe, Anne Wojcicki. She put up $300 million winning bid against Regeneron, and so the judge is going to hear arguments about whether or not this transaction can take place. And there are 27 states, along with D.C., the AGs there, they do not want the sale of this biometric information, this very sensitive data that the company is holding on 15 million Americans. And they say that it doesn't matter whether the sale, and I should mention that it's a nonprofit that Wojcicki formed in order to buy these assets of 23andMe, not her personally. But regardless of whether it's a nonprofit that it goes to, whether it's Regeneron, these states don't want this information transferred because why? They say, well, the consumers didn't consent to this happening, that transferring to another company wasn't part of the original deal. And if you want to have this deal go through, you need to go to each and every one of these consumers and ask them if they reconsent to their DNA genetic biometric information being transferred. So So there are currently 19 states that have specific laws on the books that do protect this kind of data. But the murky legal area here is that there's no federal law at all. So it's really kind of a case-by-case, state-by-state basis. And a lot of this depends on where the consumer lives right now, not necessarily where they lived at the time that they signed their agreements, their original agreements with 23andMe. In a filing yesterday, Texas, which has been leading a lot of the pursuit of objection here, they said that the court doesn't even have jurisdiction to allow this transfer. And they also called the sale or the attempted sale an insider transaction intended to evade the state's laws. And they also said, Texas did, that they're trying to avoid the liability from that very large 2023 data breach that 23andMe had, where 7 million consumers' data was compromised. Also, on top of that, you had today the United Kingdom and authorities in Canada working together to pursue and assess from the UK a $3.1 million fine on the company. They said that the company, that it's over the same breach and that the company continues to be in breach and needs to come back into compliance. They also say they're in contact with the U.S. trustee, which is overseeing as the watchdog for the bankruptcy case. So a lot for this company to work through to get this transaction to a finish line.
You mentioned there, Alexis, 23andMe, if you're a user, your data, you said, is not protected by federal laws. Why is that?
Well, biometric data has not been taken up by our U.S. Congress, and they have not written a law and gotten it passed and signed into law. So it's up to the states at this point. And right, this is how a lot of our technology-oriented problems evolve. They start at the state level, and so right now it's really up to those states. There are some general consumer protection laws that the FTC has in terms of being honest and forthright with your customers, but in terms of this very specific type of data, it's going to be up to where you live at this point.
All right. Thank you, Alexis. Appreciate it. Coming up, we are taking a look at the best ways to be positioned within the energy sector with our investor playbook. Stick around. Much more market domination. That is still to come. Oil prices moving again as the conflict between Israel and Iran enters its 5th day. The geopolitical tensions rippling through the broader energy sector. We're navigating how to play this space with the Yahoo Finance Playbook. And joining us now is Rob Thummel, Senior Portfolio Manager and Managing Director at Tortoise Capital with nearly $9 billion in assets under management. Rob, always good to see you, especially on set.
Thanks for having me.
So listen, geopolitics dominating the headlines, Rob. Israel-Iran war, it's running hot. You saw President Trump, who was posting today, he's demanding Iran surrender. And you look at oil, it is moving higher today, Rob, but I'm looking at WTI, it's still sub 75 here. I'm curious what you make of that response and reaction in the oil markets.
Yeah, well, I think if you just look at really, is oil being disrupted? No, the answer is no, Josh. So I think the markets are not being disrupted. The flows are still happening. I mean, the key thing to watch is, of course, the Strait of Hormuz, and that's where 20% of the oil goes through, and that's straight. And if that's disrupted, then you're going to see oil prices rise. Without that happening, and I don't think that's probably going to happen, you're going to probably see oil prices trend downward. And if you look at the futures curve, I think it's obviously indicating that because we just think that there's going to be an oversupply of oil in the market. Oil prices will come down. And that, frankly, will be a good thing for consumers because that means lower gasoline prices for the summer.
I mean, it's interesting in the meanwhile, though, to see. I mean, yesterday, to your point, we saw oil prices come down because of what you're saying. There wasn't a widespread belief that there would be disruption through the Strait of Hormuz. And then today they're going right back up again because of the at least possibility that investors seem to be considering that things will be ratcheting up. So as an investor, how do you buy insurance against that possibility? Or do you just say it's so unlikely that I'm not even going to put money down?
No, I think it's a good observation, Julie. I just think it's so unlikely if you just think about it. I mean, 20% of the oil markets, if we had the Strait of Hormuz, some disruption there, I mean, we've got a global energy crisis immediately if you think about it, right? And so it's not in the interest of the two largest consumers of oil in the world, the U.S. and China. It's frankly not even in the interest of Iran because Iran obviously generates a lot of revenue from oil.
So is your point, Rob, if there was disruption in the Strait of Hormuz, U.S. and allies would immediately make a move?
Yes, that's exactly exactly it.
Right.
That's exactly it, Josh. Because nobody, like I said, nobody in the world wants this global energy crisis, and it would be one immediately. And so there would be actions taken, I think, very quickly to remedy and have the ships then start to float back and forth and get out of the Strait of Hormuz at that point.
So absent that, where's fair value for oil right now? Why do you think it's going to come down, and how far?
Well, in the short term, I think it's probably, Julian, I think it's in the 60s, probably maybe in the 50s for now. The market's going to be oversupplied. OPEC Plus is bringing back volumes. But we think, in the U.S., we're going to see we might see a lower production next year, actually, for the first time for a while. Now, we think that's temporary. I think the longer-term oil price is probably right where we are right now, right in the 70s. And we'll see oil prices come back up. But we got to get the oil market balance, and you got to get some of these oil volumes from OPEC Plus that were off the market back onto the market.
So, Rob, let's talk about, you have to decide where to put money to work. Let's talk about some places where you see opportunity in this sector. One was Constellation Energy, largest nuclear energy play. Why is that a smart opportunity here?
Yeah, Josh, because we think that electricity actually is the new oil. So we've got this revival of energy. The sector is going to be changing in a lot of ways, and we think that electricity becomes the new oil. Where do you get a lot of electricity? You get it from nuclear and natural gas. And so Constellation Energy, one of the largest, the largest nuclear operator, generates a lot of electricity. It's in the right location, really in Pennsylvania and the eastern area of the country, generating a lot of energy for that area. And because of AI, where are all the AI data centers, or where are the most in the world? Well, Northern Virginia. So anyway, we see that as a huge opportunity for Constellation.
It's so interesting to me because I think of you. I mean, we've been talking to you for years, and you're an oil stock guy, right? This is how we've come to know you, And so it's so fascinating to me that, when we asked what you were liking right now within the market, it's not oil and, exploration and production names, the traditional big oil names. It's these other types of energy companies. On the flip side, you're not the only one noticing this, right? These types of companies have gotten a lot of money into them. And as a result, the valuations have gone up. So how are you thinking about their popularity?
Yeah, no, Julie, and you're right. I've been investing in energy for 30 years, and at Tortoise, we look for opportunities across the whole energy value chain all times. And where are the most commercial opportunities? And right, we've talked about oil for years, and look, oil's still relevant and it's still important. But we just think that natural gas and nuclear will be the engines really that drive this AI trend, that help really drive AI and help drive electricity going forward. And so that's really why we have, I wouldn't say changed at all, but we've just evolved because the energy sector is evolving. The energy sector is being redefined. And so that's kind of how we've gotten into this position. And frankly, it's an exciting one for all the reasons that you've articulated. But it's a really exciting opportunity in energy because it's for the first time in my career where you've had energy and technology kind of merge together, and both need each other to be successful.
Here's another one you like, Rob, which is interesting. A uranium miner, Cameco Corporation. Explain that thesis to us.
Well, so if we're going to develop nuclear, we need to develop the nuclear supply chain. So that starts all the way from developing and having more uranium production. That's what Cameco does. It owns, I think, about 17% of the world reserves in uranium, and so that's where it starts, is with basically the mining of uranium, and Cameco is one of those companies. Then you need to enrich it, and there's some companies that aren't on the list yet that we like, that you need to enrich more uranium in the U.S. This is a little ways away yet until we get uranium being more of an important part of the or nuclear being a larger part of the energy supply chain. Natural gas, in the meantime, is going to be probably the biggest and the best opportunity to capture growing electricity volumes.
I want to bring it back to valuations for a minute because, as I mentioned, Constellation has been bid up, and as a result, its valuation has gone higher. That's true of pretty much all the other names that you like, and pretty much anywhere you look in nuclear. Yeah. We have seen a lot of money, and in traditional power companies, a lot of money going in. So how do you think about the valuations? Is it too late for someone not like yourself who hasn't been looking at these, who's new to coming in? Have they kind of missed it?
Yeah, and that was your question earlier, and so I apologize.
That's
for
okay.
That. But you're right. It's been a great run for these stocks, but we just think that there's significant growth opportunities going forward related to this, because just think about just think about the demand for electricity. We need 1,000 more terawatt hours of electricity between now and 2030. You're like, what does that mean? Well, it's the same amount of electricity that's currently being used in the states of California, Texas, New York, and Florida together, combined on a retail basis. So there's a lot of electricity, and so there's a lot of growth that's ahead for companies like Constellation, companies like Avistra, a lot of these electric utilities. You think about it, these stocks historically weren't known as growth stocks. They were defensive stocks. Now they're still kind of defensive because we still need electricity, but now because of AI, they're now growth stocks too. So they're going to attract new investors as well, we think, which will result in improved valuations going forward. And so there still are opportunities here.
Rob, always good to see you, especially in person.
Thanks, Josh.
While wrapping up today's Market Domination, don't go anywhere. Stay tuned for Market Domination Overtime.